Dear investors, on behalf of Bellevue Asset Management, I would like to welcome you to our update call on African opportunities. My name is Tanya and I will be your host during the call. The negative impact of COVID-19 on the global economy and market has also affected Africa. On a cases per capita basis, African countries were quick to introduce confinement measures to counter the virus spread. As a result, business activity fell steeply, with the leisure of tourism sectors suffering the most. In our opinion, the impact of the coronavirus will expose the vulnerability of countries that were slow to reform, mainly South Africa, Nigeria, and other commodity exporters in sub-Saharan Africa. Now I'm delighted to introduce Andy, who joined Bellevue in 2015 as an analyst and portfolio manager for the BB African Opportunities Fund. Prior to that, he was a senior analyst at Exotics in London, covering brewer and cement companies listed in Africa. In the following minutes, Andy will talk about the performance in Q1 2020 and the current lessons learned from the crisis, as well as venture a brief outlook. Now I would like to show you the agenda of today's call. First of all, Andy will give you an update on the COVID-19 impact on Africa. Afterwards, we will move on to the performance. And last but not least, the positioning and outlook. Furthermore, in the annex, you will find the facts and figures about the fund. Andy, please take over.
Thank you very much, Tanya, and welcome to all of you joining us on this recording discussing Africa in the context of the COVID-19. Going straight to the first part and a quick snapshot of the current situation, the total number of active cases in the region stands at around 15,700 compared to 5,200 cases in late March. On the right-hand side of the slide, we show a map with a quick overview of the situation by market. Morocco, Egypt, and South Africa being the top 3 countries in terms of active and death cases. Having said that, it is important to recall that looking at the number of cases per capita, African countries were among the quickest to introduce containment measures to slow the virus spread. It all started in the first half of March with travel bans to and from affected countries in Europe and Asia. Then the restrictions were progressively extended to more domestic confinement measures. Today, the situation varies from one country to the other, for which there are either night curfews or partial lockdown, and for the most stringent, a full lockdown like in South Africa, Rwanda, and Zimbabwe. Lots have been said on the real impact this pandemic will have on the population. Of course, looking at the fatality statistics of the COVID-19, Africa might be cushioned by its young population. However, a weak healthcare system and the lack of testing could slow the efforts to control the pandemic expansion. What we are certain of today is that we are still at an early stage and a careful monitoring of the situation is clearly needed. Still on the direct consequences of the COVID-19, economic damages were quickly felt in commodities exports or in the hospitality and consumer discretionary sector. But before we touch on this, we think it's important to flag that the various restrictive measures imposed on the population today could have a social cost, not necessarily measured by the official tools tracking the formal economy. Because of the high number of population, the high number of people relying on informal jobs for their daily revenue, there is a risk that long-lasting containment measures lead to a deeper than expected revenue loss for the whole population. Hence, we wonder if some African countries can really afford to keep the current restrictions for a prolonged period of time. That is something that we keep in mind when assessing the evolution of the situation on the ground. Now, coming back to the economic impacts and moving on to the next slide, one of the immediate outcomes of the pandemic was a hit to commodities exports and tourism, both representing a big source of US dollar earnings for African countries. Starting with commodities exporters that generally earn more than 50% of the FX earnings from this source, they suffered a lot from the fall in commodities prices amid lower global demand. Nigeria, for example, Africa's biggest oil producer, whose oil exports represented close to 50 billion US dollar in 2019, was particularly affected in Q1 this year. Other nations like Angola, still for oil, or Zambia and DRC for industrial metals, are also affected by similar trends. Now on tourism, the abrupt cancellation of flights worldwide brought the industry on its knees. And countries like Egypt, Morocco, or Kenya, for which tourism represents on average 15% of their current account receipts, are also affected. Net-net, the swift drop of foreign exchange inflows led most African countries that we cover to tap into their FX reserve to make up for the deterioration in their current accounts position. Of course, African countries that are net oil importers should benefit from lower oil prices. And the general fall in internal demand across the region will keep a lid on US dollar needs for import. But one less volatile source of US dollar that is of help in such difficult periods is remittances. And these remittances could be significant, like in Egypt or Nigeria, where it stood well above 20 billion last year. We think these remittances could act as a buffer as long as the COVID-19 related recession in developed economies does not last for too long. Lastly, a short-term relief could also come from the moratorium on debt obligations recently granted by development financing institutions and the Paris Club. But these measures will not be sufficient, and we do believe that structural adjustments are still needed to address the currency risks in the medium term. Talking about currencies lead us to the tightening of financial conditions that came along with the global risk-off environment. And on slide 6, we presented on the left-hand side the year-to-date performance of key African currencies against the US dollar in green, and the same for EM currencies and the euro in gray. From this chart, it appears clearly that big commodities exporters saw their currencies underperform that of other currencies less reliant on this FX source. The South African rand stands out as the worst performing because of the country's economic woes that led Moody's to downgrade its rating to sub-investment grade. Other currencies fared better in line with EMPs and the euro, with the Egyptian pound standing out as the strongest, probably supported by the central bank. On the right-hand side of the slide, we show the yields of Eurobonds with the shortest maturities, more specifically how yields moved between the beginning of the year and the end of last week. Once again, this chart paints a tough situation for commodities exporters as they saw a stronger move upward in yield, which means that it got more expensive for them to accept the debt market, either for their new fiscal needs or to refinance their existing debt. Zambia, with yields shooting up to 50%, is already seeking to restructure its debt. The latter risk could materialize in Nigeria or Angola, contrary to South Africa until now, that still benefits from a well-developed market domestically. The next slide of this chapter is still on the tightening of financial conditions. That is also visible in the yield curves we show on the right-hand side of the slide. This last week, we saw most central banks in Africa, like others worldwide, cut their main policy rates aggressively. And as you can see on the chart, this had an impact on the short end of the curve that fell year to date. But contrary to the moves in more developed countries, the long end of the curve steepened in our core market. This is a clear sign of tighter financial conditions, as yields seem to be pricing a deterioration in fiscal position, even though some countries like Egypt or Morocco still have ample room for additional fiscal and monetary stimulus. On the left, we presented the maximum drawdowns and total returns year to date for the main equity markets in Africa, and we compared these figures to those in the rest of the world. What is striking from this chart is that the peak to through was fairly similar across all equity markets. However, the rebound seems to take more time to materialize in Africa. In our view, there are two main reasons behind it. First, the region is the last to benefit from global capital flows. And second, the size and means for local monetary and fiscal support are generally limited compared to what institutions in the US or Europe can do. So how do all these developments that we just discussed affect our performance? To answer this question, let's move to the next chapter where we summarize on one slide the year-to-date performance of the Bellevue African Opportunities Fund. Since the beginning of the year, the fund lost around 23% in euro terms. Our markets were hit by heavy selling from foreign investors, especially as emerging and frontier markets funds suffered record high outflows post the COVID-19 outbreak. The buying appetite from local investors and certain Africa dedicated funds did not come before a double-digit drop in equities and also the first announcement of fiscal and monetary stimulus. We managed to outperform our benchmark and peer groups thanks to our underweight on commodities names and our underweight on countries that are big commodities exporters. But we lagged the equity market rebound in developed markets, particularly that in the US, as you can see on the bottom left-hand chart of the slide. And it appears clear to us that lower valuation multiples do not offer a stronger support to short-term performance compared to the massive liquidity injection seen in developed markets. Having said that, what's next? How do we position ourselves going forward? We thought it easy and simple to discuss it by showing you on slide 11 a few names that we have in the portfolio and that showcase pretty well the opportunities we see in our region. Those three names are Crédit Agricole Egypt, a subsidiary of the French banking group, Oberland, the largest white cheese producer in Egypt, and Vivo Energy, the leading independent fuel distributor in Africa. All three names are leaders in their specific domain, and were already trading at cheap valuation multiples before the COVID-19 outbreak. The latter made them even cheaper and more compelling cases for the future in our view. Obviously, one could always argue if a stock is cheap, there is always a reason for it. However, we do believe that in these cases, this isn't right, because using past crisis EPS behavior in 2020 earnings, and here we talk about EPS fall of more than 30%, that would leave expected valuation multiples still very attractive for those names. And once again, don't forget that these companies that we own have a strong competitive position, a solid balance sheet, high return on equities, and pay some good dividend yield. So we're pretty comfortable with the core holdings we have in our portfolio. The last slide I will be presenting today shows us how we deal with the challenges coming with the COVID-19 outbreak. The first way we approach this situation is with a continued focus on liquidity. As for us, a liquid portfolio offers the flexibility to react to fluid situations. It also helps us avoid being forced to sell under pressure. What we do in practice is we trim the less liquid names on rebound, while our holdings offering large dividend yields come as a support to our cash position on dividend payment dates. The second way to face these challenges is to be selective with the risk we take and prioritize capital preservation. This is implemented through our reform-driven investment philosophy, as we do believe economic reforms improve growth prospects, but also offer buffers in crisis times. We also avoid countries facing a wrecking economic crisis that could materialize via debt defaults, FX shortages, or banking crises. Overall, we remain invested and look through economic slowdowns as long as terrorists are avoided. A third point we pay a particular attention to is to remain close to corporates. For this, we leverage our extensive network on the ground, and this helps us stay updated on the situation on a daily basis. These regular contacts with local sources are very important, especially during a crisis, as they contribute to formulating the appropriate decisions timely. And lastly, we invest for the long term. This is our strategy focus, even if we sometimes tactically manage the short term because of the recent developments. This long-term approach is for us the best way to leverage Africa's potential. And despite some challenges like what we face today, we are confident that short-term losses can be recovered, assuming our perception of future prospects are not impaired. I will now end this presentation here and invite you to contact us directly if you have any question or comments. Thank you all for your time and interest in what we do in Africa. And Tanya, over to you.
Thank you very much, Andy, for the interesting update. I can well imagine that this has confirmed our investors in their position and perhaps also highlighted some opportunities. On behalf of Bellevue Asset Management, I would like to thank you very much for your trust. And should you have any questions, your personal contact person will be happy to answer them. In this spirit, I'm wishing you successful business and stay healthy.